Vyas Balasubramanian, Head of Risk at Colonial First State. Thank you very much for participating in the Inside Network's Investment Leaders Forum here in Byron Bay.
Thanks, James, for having me.
How has the approach to portfolio construction evolved, Vyas, with the increasing availability of data analytic and technological tools?
Yes, I think things have changed a lot with data and technology and how that's improved and how that's changed portfolio construction. So really what has changed is, there's probably two things I'd like to talk about. Firstly, around the amount of data, and then secondly, how to use that data, the tech and the data visualization that has come about, the changes in how you can see that. So there's a lot of data. There's a lot more data. I think everyone knows that now. For us in our organization, we have access to so much more data now than we had in the past. And as an example, for one of our diversified funds, if you look down through the managers to the individual assets, you can get up to 40,000 lines, 40,000 individual assets. That's a lot of data. Being able to look at that every day, compared to when I started in the industry, you could probably look at it maybe once a month or once a quarter. So just so much more data. You can look at what managers are doing. You can look at how your portfolio is performing. You can run lots of different simulations because of the data, and the speed of computing power has changed a lot. So just so much more access to information. And secondly, how you view and visualize that data. There's a lot of business intelligence and visualization tools and software now. And so you can just get so much rich access to what's going on. You can build dashboards, you can present that to investment teams, you can present that to CIOs, to advisors, really to anyone, and you can drill through and look in and get information, really. So it's really all around data and tools to access tech, to access that information.
In today's market environment, what are the really crucial considerations for building a resilient investment portfolio?
So really, what are the ways that we can build resilient portfolios nowadays, especially in today's market environment? I think the answer would be the same, whether it's a normal environment or especially in these environments. It's really around deep understanding of your portfolio. Being a quant and having a systematic background, that's probably what I would say. You really need to understand what's in your portfolio and what's happening. So there's probably two main ways I'd like to talk through this. At an asset allocation level, how can you understand your portfolio? And for us, a really key way to look at our portfolio, have an understanding, and to make it a resilient portfolio is through creating custom scenarios and then putting our portfolios through it to stress it and to see how it would perform. And so, for example, right now we're worried about inflation. And so there are a few scenarios that we have built around our concerns around inflation. So we could have high inflation that could be coupled with strong growth. We'd call that an inflationary boom. We could have a scenario where we have strong growth but low inflation, a disinflationary boom. Or we could have what we were worrying about last year, which was both equities and bonds falling, a hard landing, or the correlation breaking down. So these are three scenarios. You can really come up with multiple scenarios and run the portfolio through that. So at an asset allocation level, you can really understand what your portfolio might do, and hopefully you can build it so that it performs well in the scenarios you're worried about. So that's one way of building resilient portfolios. Then if I step down to the next level, at a manager level, again, it's really understanding the managers and which managers you have and what their styles are, what their styles may be, and how that might change. And so traditional theory, especially at a manager level, will tell you that you combine managers that have different exposures, or ideally are nearly or lowly correlated. That works or can work in theory. What we find is sometimes that correlation breaks down and sometimes you don't get what you think you're going to achieve. And so I'll give you an equity example here. Looking at equity growth managers and equity value managers, typically people will put those two portfolios together. So if we look at 2020, 2021, 2022, a great case study of how this can work and how it cannot work. So 2020, we had very strong growth performance. Growth managers did well, value managers did poorly. In 2021 and 2022, the opposite occurred. We had growth managers underperforming, and so the hope was that your value managers would outperform and counteract the underperformance of growth managers. And so the growth managers did underperform in 21 and 22. value managers, not quite so. There were some that did, but there were quite a few that didn't. Why was that the case? I think a lot of the value managers had a very poor 2020 and got a little bit nervous. I think some of them might have changed their process. They got out of the really value stocks that did rebound in 2021 and continued in 2022. And so at a portfolio level, if you put those two managers together, it might not have been the right outcome or the outcome you thought you were going to get because that negative correlation broke down. And so what I think is a preferred approach there is in the extremes. I think it's preferable to not be in the extremes of styles, whether that be value or growth. Having a bit more of a risk-controlled approach means that you can be more assured that correlation will occur when you want it to. And so when we're picking, in this case, equity managers, value and growth, we try and find managers that have a bit more of a risk control lens in how they approach the portfolios. And that gives us more assurance that the correlations won't break down and we're building more resilient portfolios.
What role do alternative investments play in your portfolio construction philosophy?
Yeah, so what role do alternative investments play? What I take alternatives to be at this stage is I'll say that it's everything that's not listed equities and fixed income. And so I guess the way we think about this is betas are provided into the portfolio. So equities is the primary beta in most diversified portfolios. Second sort of large beta would be fixed income. And within equities and fixed income, obviously you can get an Australian beta and then a global beta. And those sort of four betas, Aussie, global, equities and fixed income, cover a large portion of most diversified portfolios. So from that base, really what I think is what can you add to that? What betas can you add to that to provide something different? Ideally a different return stream, diversification or a risk reduction in the portfolio. And so when I think of alternatives, it's what asset classes or what individual alternatives can you add to that? The first few, for example, unlisted infrastructure, real estate, or private equity, if I bucket those three together, they provide a different return stream, primarily because of the liquid nature of the asset class, but you get a similar economic exposure to the listed counterparts. So you do get some diversification benefits. So they can be added in to a certain extent. From a purely quantitative perspective, other alternatives, so I'm thinking things that are a little bit more esoteric, commodities, natural resources, litigation finance, catastrophe type of insurance, payoffs, insurance related investments, and so on, provide a much more uncorrelated return stream. So from a quantitative perspective, they look great. Qualitatively, that's where you need to think through what is the return source that I'm actually getting from these assets? Is it sustainable? Is it what I want? Do I believe in it? And if I do all those things, then how am I going to achieve this? Am I going to do it directly or am I going to do it through a manager? And then you need to put that in. So I sort of really think this through from a betas perspective and the role that alternatives can play. At CFS, we have sort of two philosophies that overarch all of this. The first one is that asset allocation is the primary driver of returns in a diversified portfolio. And secondly, unlisted assets can add value, can have benefits to a portfolio, either from a return or from a risk perspective.
Lastly, could you share a recent challenge in portfolio construction and how you addressed it?
Yep. A recent challenge that we've had in portfolio construction was around our Australian equities multi-manager portfolio. And that's where we bring together a handful of Australian equity managers into a single portfolio. And the challenge was that the portfolio was delivering returns, but it was delivering less returns than we had hoped for the risk that we were taking. And so it was a problem initially of too much risk and not enough return. And so then we worked through the process, and I'll tell you in a second, and it ended up being a portfolio construction challenge and opportunity actually. And so what we looked into that, because we have full look through all of our portfolios, we had individual holdings going back a number of years, back to 2008. So we put all the data together. We did some sort of, systematic analysis into what was going on in the portfolio. And to cut a long story short, we found that in the largest segments of the market, the bigger stocks, our managers weren't doing as good as they could have done. They were taking a lot of risk. About 60% of their risk was, 60% of their capital was being allocated to this area. 40% of their risk was being taken, and they were generating negative returns from there. So it wasn't what we wanted. And so that research showed that. Then what we did, the next piece of research was what happens if we told these managers to not allocate to the larger stocks. As you'd expect, returns were better. What was interesting was the risk really came down because they were taking essentially unrewarded risk, and we don't like that, obviously. So they were taking less risk, and as a consequence, which may be obvious, is that you don't have to pay for fees if they're not allocating to a certain sector of the market. So looking at those three building blocks, returns were improved, risk was reduced, and we ended up paying less fees on this Australian equity allocation. So what started as a risk return problem ended up being a portfolio construction problem of how we direct our managers and how we put the portfolios together. And we ended up with, so far anyway, a much more improved portfolio from a risk return and fees perspective.